I would argue that point one is even kind of a silly number. I think it's easily going to be 1%. So that's 300 billion. But what we saw was a bunch of the big guys said, oh, no. Even though this is a BlackRock or Fidelity approved ETF, we're still not going to let you buy it with your money.
Hey guys, welcome back to Everyday Finance. In this video, Yusko discuss about Bitcoin ETF and other crypto. According to Yusko, we've talked about all the different predictions of how much money that would bring in, from 30 billion if you know clients who are locked up in these brokerages firms that haven't been allowed to take part. It's about $30 trillion, pick a number, and 0.1% of that would be 30. And you know that would make the market move. We've seen about, it doesn't happen on the first day, but about a third of those see a little more than 10 come this way. That 0.1 is even a silly number. Yusko think it will be at least 1%, which is 300 billion. But what we saw was, a lot of the big guys said, oh no, even though this is a BlackRock, even if it's a Fidelity-approved ETF, we won't let you use your money to buy it. People said, Yusko, just leave and go somewhere else. But he think they're going to finally. If they change their minds, that money will keep coming in every day. And lots of things Yusko discuss. So please watch the video to end. And share this video and subscribe our channel Everyday Finance. Thanks.
Absolutely, as you described, right? You know, the idea that all of the money, right? We've talked about all the different estimates from, 30 billion if, investors that the captive investor base in these brokerage firms that haven't been allowed to participate, is roughly 30 trillion, pick a number. And 0.1% would be 30 billion. And that would move the market. And we've seen about a third of that. We've seen a little over 10 kind of come this way. But it doesn't happen in day one. And it gets, I would argue that 0.1 is even kind of a silly number. I think it's easily going to be 1%. So that's 300 billion. But what we saw was a bunch of the big guys said, oh, no. Even though this is a BlackRock or Fidelity approved ETF, we're still not going to let you buy it with your money. So people said, well, I'm out, right? I'll just leave and go someplace else. But eventually, I think they're going to change their minds, and that money will continue in right now, every day, and we'll see how long it lasts. But I think it's going to last for a while. Every day, the ETF complex is buying roughly 3 times the number of Bitcoin that are mined. So we got the halving socks on today, and that's only for the next 3 months. 3 months from now, that number goes from 900 to 450. If the same pace keeps up, which I think is pretty likely, you're going to be talking 6 times the daily production. And so that is a supply-demand imbalance that will lead to rising prices. And I mean, people have heard this from me ad nauseum. Rising prices beget rising prices, right? Once an asset starts to move, people are drawn to it. That's the way it works. And that will push us past fair value into, silly levels sometime in the crypto fall that'll start, next June. And a year from now, I think we'll be talking about, oh my gosh, how did we get to triple digit Bitcoin? And when's the bear market coming? Because there will be another bear market, because the FOMO gets really extreme as you start to go parabolic in any asset, like NVIDIA right now. I mean, Tesla before. I mean, NVIDIA right now it's amazing to watch.
According to Yusko, now there are more inactive index funds and ETFs. Passive is do not passive. This is the tweet Yusko sent the other day. In the last 20, only 31% of companies that went public. Still, there are still people there. Just think about that number. 69% of them are gone. Number of it's just slow, but what they are is letter weighted, which means since they have to buy more of something as it costs more, they become more and more focused, We saw this happen in 2000, and it gets silly after a while. After 286 years, people finally wake up and say, "Oh, that's bad. You made a mistake, and now we're back. And you got all of these firms that trade 100 to 100 times, making 30 to 40 times sales. And people don't like it." It's a different list of the 4 most dangerous words in trading. It will end when people try to short it. Let's back to the Mark Yusko interview.
No, it's why we have the Mag 7, right? We have now more passive money than active in the United States. What does that mean? We have more index funds and ETFs, passive. Now, passive, by the way, is not passive. I tweeted this out the other day. In the last 20 years, only 31% of companies that went public still exist. Think about that number. 69% of them gone. So there is turnover in these indices. It's just slow. But what they are capitalization weighted, meaning they have to buy more of things as they become expensive. So they get more and more and more concentrated. And we saw this phenomenon in 2000, and you get to a point where silliness, right? Cisco at 286 times earnings, and people finally wake up and say, "Oh, that's bad." And you have a correction. And here we are again. And you got all these companies now trading 100, 150 times earnings, 30, 40 times revenues. And people are like, no, it's different this time. 4 most dangerous words in investing. And it will end. But when people try to short it, and we've talked about this before with MicroStrategy in 2000, you can try to short the stupidity. And MicroStrategy in 2000 is very different than NVIDIA. It's more like Cisco and Microsoft to NVIDIA. Perfectly good. Or Intel. Intel went up 20-fold. Think about that. It went up 20-fold in 4 years because it was going to change the world with AI. It's funny. Back in 2000, they were talking about AI. And now it's down 40% since then. So, because it got, displaced. And I saw the CEO of NVIDIA on the other day talking about, the entire structure of computing is changing, and we're leading that. And this is great. I love people who are humble braggers. I mean, he's very soft spoken, and we're the only company that gets this. Really? You think you're the only company in the world that gets that we're in a transformational move in computing? Okay, fine. I have a few companies that would disagree with that, but if you short that in a momentum world, you get knocked down. So, totally agree with you. And actually, we have data on this. So the volatility, it's from this side. Volatility is trending down. It's reversed on my screen. I can't do it. It's confusing my brain. But volatility Bitcoin was triple digits when it started because it was a science project. There was no there. It was super vol, a little penny to 2 pennies. That's a 100% move. But as it has gotten more mature and gotten bigger, that volatility is now trended down. It's like in the 40s, long-term still closer to 65, 70. But we're definitely going to trend down. And it's because the passive holders, hodlers are part of that, but now the ETF is structurally a passive holder. Leverage is also down. So there's not as much leverage and as much speculation. There will be more leverage. Leverage will come back, but there's not as much as there was. So I don't disagree with that at all. But the passive versus active debate is a tough one because the more passive there is, the more you just keep reducing the supply, and that's like a supply shock. And that 3% number is actually probably not right. Not that your number's not right, but I just saw this stat. No, I just saw this stat that kind of blew me away. I mean, I knew the lost or stolen component of Bitcoin was big, but I never saw it in a visual. The estimate is that 5 million of the 19 million coins that have been mined to date are untouchable. Lost, stolen, stuck in multi-sigs where somebody's passed, or that's a big number. And even if it's not right, it's probably not off orders of magnitude. And so that 3% is probably more like 5% and trending to a very large number. So, supply shocks will lead to higher prices.
Mark Yusko said we're definitely going to trend down. It's because the passive holders are part of that. But now the ETF is structurally, a passive holder leverage is also down. So there's not as much leverage and as much speculation. There will be more leverage will come back. But there's not as much as there was. So Mark Yusko don't disagree with that at all. But the passive versus active debate is a tough one because the more passive there is, the more you just keep reducing the supply, and that's like a supply shock. And that 3% number is actually probably not that your number is not right, but Yusko just saw this stat that kind of blew me away. He knew the lost or stolen component of a Bitcoin was big. If you learned something from this video, then please like this video and subscribe our channel Everyday Finance, and we will meet in next video. Thanks.